Good morning. The Senate Health, Education, Labor, and Pensions Committee will please come to order. Today we're having a hearing on how we can strengthen people's finances and improve their retirement security. I will have an opening statement, and then we will introduce our witnesses. After the witnesses give their testimony, senators will each have 5 minutes for a round of questions. We are again unable to have the hearing fully open to the public or media for in-person attendance today. Live video is available on our committee website at help.senate.gov, and if anyone is in need of accommodations, including closed captioning, reach out to the committee or the Office of Congressional Accessibility Services. The COVID-19 pandemic upended our economy, and with it, the financial security of people across the country. I have heard from families in Washington State who were forced to raid savings meant for their futures just to make ends meet, savings for their kids' college fund, a down payment on a house, or for their retirement. And that's not even the half of it. Many people across the country have never even had access to a retirement plan and never even been paid enough to make ends meet, let alone save for their future. COVID-19 was exactly the kind of crisis millions of families simply could not afford. That's why we worked in a bipartisan way in the CARES Act to give people more flexibility in managing their retirement resources and making ends meet during this crisis. It's why I worked in the American Rescue Plan to save workers and retirees from having the benefits they rely on slashed, and it's why Ranking Member Burr and I are now working to pull together bipartisan ideas in this space and move a retirement legislative package later this spring. I hope our discussion today will inform and improve these efforts, and our Democratic and Republican colleagues will continue to bring forward ideas over the next few weeks so we can build a good bipartisan package that helps workers, retirees, and families. Because it is painfully clear we need to do more to strengthen people's emergency savings and retirement security. When it comes to emergencies, financial experts say families with low incomes really need enough emergency savings to get through 6 weeks. Before this pandemic started, almost 2 in 5 Americans would struggle to get $400 in an emergency. We need to give workers and businesses tools that make it easier for families to put money away for a rainy day so that sudden expenses don't upend their lives in ways that undermine their finances for years to come. And when it comes to our retirement system, it's clear retirement plans right now just aren't working for most Americans. When too many workers don't have access to one, when 1 in 9 of those who do have access to a retirement plan do not participate in it, when 1 in 6 don't think their retirement savings will even last a decade, and when people often inadvertently lose retirement benefits when changing jobs. TIAA estimates 30% of Americans left a retirement account at their previous employer. And according to the Government Accountability Office, millions more have left 2 accounts behind, all to the tune of billions of dollars workers earned, saved for their future, and simply aren't able to use. We need to fix that, and I know Senator Warren and Senator Daines have a bipartisan bill to address this issue of lost and found retirement accounts. There are also ideas for how we can better increase participation in employer-sponsored retirement plans through Re-Enrollment, as well as bipartisan ideas for how we can get more people retirement options in the first place by building off steps we took in the Secure Act to make it easier for small businesses to offer quality retirement plans to their employees and expand which employees are eligible to participate in them. I pressed hard in our work on the bipartisan Secure Act to make millions of part-time workers eligible for their works retirement plans, and I've continued pressing to make even more people eligible in my Women's Retirement Protection Act. I know Senator Casey and Senator Scott have a bipartisan bill on that as well. Of course, we also need to make sure that when people have retirement plans, they are given the tools they need to make the most of them as well. For example, tools to help people manage spending down their nest egg so they can make retirement resources last for the rest of their lives, and clear and complete information they need to make decisions that will affect their financial security for years to come. Unfortunately, a GAO report I requested found that fee disclosures currently provided by 401k plans simply are not cutting it. Looking at current fee disclosures, 4 in 10 people in a plan incorrectly believed they were not paying any fees. And the stakes are even higher for retirees when they are forced to consider whether to take a lump sum and trade a lifelong pension for a one-time payout. GAO found financial disclosures people were given to consider these huge financial decisions often skipped details, like how the value of the lump sum compared to their existing benefit, or the fact that accepting a lump sum would mean losing federal protections. I've previously introduced legislation to change this. I hope we can get that done soon. Speaking of federal protections, 401ks, by far the most common type of retirement plan, currently are not required to have spousal protections like defined benefit pension plans are required to have. These protections make sure a spouse cannot make decisions with huge financial consequences, like rating a couple's retirement resources without their partner's knowledge and consent. I've called to strengthen these protections before, and last week Senator Byrd joined me in asking GAO to look at how steps like this could help people. When it comes to the issues we are talking about today, it's clear there is a lot of bipartisan interest in enhancing Americans' savings, improving their retirement planning options, and strengthening their financial security. I'm hopeful today's hearing will help me, Senator Burr, and our colleagues on both sides of this aisle to put together a package that builds on the Bipartisan Secure Act we all worked to pass in 2019 and the bipartisan legislation the House has been developing with even more common sense steps to make our retirement systems work better for families in Washington State and across the country. And of course, we all know emergency savings in retirement are just the tip of the iceberg when it comes to issues that can undermine people's financial security. There are big challenges throughout our economy, like low wages, pay discrimination, high costs for childcare, health care, burdensome student loan debt, and more. Costs that, like investments, compound over time and set workers back by hundreds of thousands of dollars, in some cases millions, by the time they reach retirement. So in addition to steps to strengthen our retirement system and help families save lives, like we are talking about today, I'm also going to continue pushing to bring down costs, make our economy work for working families. I would like to ask unanimous consent to enter 3 letters into the record from the Insured Retirement Institute, the Spark Institute, and the Erisa Industry Committee. So ordered. With that, I will turn it over to Ranking Member Burr for his opening remarks.
Thank you, Madam Chairman, and I apologize to the committee members for my tardiness this morning. Madam Chairman, I want to thank you for scheduling this hearing to highlight the need for Congress to consider legislation to encourage Americans to save more for their futures. It's not often we have hearings on the pension part of the Help Committee, but as I look at my remaining 9 months in the Senate, I'm very aware of the importance of working and saving towards a secure retirement. Our Labor Committee hook into retirement issues is Erisa, the Employment Retirement Income Security Act. Erisa sets standards for retirement and health plans in private industry to protect individuals in these plans. The Finance Committee handles the Internal Revenue Code portion. Retirement bills require our committee to work in concert so that Erisa and the tax code properly work together to help Americans save for their own retirement. As a member of both Help and Finance, I consider my office a one-stop shop on retirement matters. Not only will I help shepherd Erisa matters through this committee, I'll also shape the work of the Finance Committee. At our last hearing, last year, we focused on defined contribution plans, the reliable superstar of the retirement world. Today, we'll examine how we can make further improvements to these plans. At our last hearing, the questions before us are simple. What's working well and what needs improvement? The answer is that the first question seems easy at the surface level. The system works great when you participate. The 2 most important words for a secure retirement are compound interest. If you put a little money aside every paycheck and let it grow, your future retirement will be a lot better off. But the system doesn't work great when individuals don't or can't participate. What we need to do is help Americans and their employers offer, operate, and fund individual retirement plans. One option we'll learn about from TIAA, which has a great North Carolina presence, is a all-smart companies should, is multiple employer plans. TIA has picked up the mantle as an administrator and an advocate for the enhancement of these plans. Under these plans, employers pool together to gain efficiencies to reduce cost and administration of plans. Less money spent on administration means more money being saved. Congress has been working to reinvigorate these pooled employer plans to get retirement plans out to the more and more work sites and employees, especially small business employees. The wonderful thing about defined contribution plans is that Americans who participate in them can pick a piece of paper and see at least two things: their name and an account balance. It's their money, and it's there. It's not a concept. It's not an accounting notation. Doesn't require a bailout. It requires personal contributions, maybe an employer match, some basic financial knowledge, and then compound interest does the work. Here's the truth. Americans need to save more. The gap between the retirement savings that Americans have and the savings they need is already in the trillions of dollars and likely to grow. Not only are many Americans struggling to keep track of their savings needs, even more alarming is how many people have no savings at all outside of Social Security. The data we've seen says that over 1/4 of non-retirees have nothing in their retirement piggy banks, many of whom are already nearing traditional retirement age. And while the long-term impact of the pandemic and economic lockdowns and the Great Resignation remain to be seen, we know that many Americans choose to tap into their retirement savings, draining assets from their intended retirement purposes. The bright side is that we've learned some good lessons. According to AARP, workers are 15 times more likely to save for retirement if they can make a payroll deduction to a savings plan at work. You don't spend what you don't see. We've also seen the success of automatic enrollment and employer matching to defined contribution plans. So the challenge to this Congress is finding ways to help employees and employers take advantage of the savings programs that already work. I look forward to hearing from today's panel about how to overcome the barriers individuals face in their own retirement planning and the barriers employers face in offering retirement plans to workers. I hope throughout the process Congress remembers that we shouldn't be trying to take our opinions of how to plan for the future and take the choices of retirement options away from individuals. The American people didn't send us here to be maternalistic or paternalistic and make their investment decisions for them or limit their choices. If we were all that good with planning ahead, we probably wouldn't have had a $30 trillion debt today. What I want the most is for Americans to control their own money, have safe options on how to invest and save, and live with a few government and industry middlemen or middlewomen as possible. Madam Chairman, I thank you. I look forward to our discussion.
Thank you very much, Senator Burr. Again, I want to welcome all of our witnesses today. We really appreciate all of you coming here. I will now introduce all of our witnesses, and I'm pleased to welcome our first witness, who has traveled here all the way from my home state of Washington. Petros Kamantris is the Managing Director and CEO of Spectrum Pension Consultants, the co-founder and chairperson of Group IRA, and a financial consultant with Intellisense in Seattle. In these roles, he has experience working with investment advisors focused on retirement issues, employer-sponsored retirement plans needing support with administration, record keeping, and more, and people looking to better manage their retirement savings. Thank you for joining us today, Mr. Kamantris. I'm always delighted to have folks come out here from Washington State. Our next witness is Ms. Rademacher. She's Vice President of the Aspen Institute and Executive Director of the Aspen Financial Security Program in Washington, D.C. Ms. Rademacher has led the program's efforts to consider how steps to address challenges like growing wealth inequality and household financial insecurity can support economic growth. Under her leadership, Aspen has developed important initiatives focused on looking at the forces that shape families' finances, like work opportunities, retirement security, wealth inequality, and more. Ms. Rademacher, appreciate you joining us today to share your time and expertise. We'll also be hearing from Cindy Hansell, the president and founder of the Women's Institute for a Secure Retirement. Founded in 1996, WISER works to improve opportunities for women to secure retirement income and educate the public about the inequities that disadvantage women in retirement. Ms. Hansell also serves as director of the National Resources Center on Women and Retirement, which WISER operates in partnership with the U.S. Administration on Aging. Ms. Hansell, glad you could join us today. I look forward to your testimony. And our final witness will be introduced by Senator Burr.
Thank you, Chair Murray, for the opportunity to introduce our North Carolina witness today. Doug Chittenden is head of TIA's client relationship team, which serves more than 15,000 retirement plan sponsors in the academic, research, medical, and cultural fields. Doug has more than 30 years' experience at TIA in a variety of positions. As head of client relations, he oversees sales, strategy, service management, and guidance for institutional clients. His team is also responsible for managing relationships with key industry and advocacy organizations. TIA has been in business for a long time, and they have a major presence in North Carolina. Last I heard, there were about 5,000 North Carolinians working for the company. Business would really be roaring if they moved all of their operations to North Carolina, but they're making a good start. TIA is most famous for providing retirement packages that serve the institutional community, historically teachers. But that's not all they do. What makes them a good witness for today's hearing is their support for pension research and their work with pooled and multi-employer plans. TIA knows trends and they know principles of sound retirement. As all of our witnesses know, helping diverse employers provide retirement to employees is complex and important business, from record keeping to fiduciary duties to regulatory compliance. Congress needs the insight of the retirement industry so that we can continue to close the access and savings gaps. We're pleased to have you here today, and we look forward to your testimony, Doug. Thank you. Thank you, Madam Chair.
Thank you. Welcome. And we will now begin our testimony. Our first witness will be Mr. Komatros. You may begin.
Thank you, Chair Murray, Ranking Member Burr, and all members of this committee for the opportunity to provide testimony in support of retirement security in America. My name is Petros Koumantros, and I am a principal and shareholder in 7 closely held financial services businesses. Collectively, these businesses work with 2,200 retirement plans, representing $9.2 billion in retirement plan assets, and support the needs of 97,000 retirement plan participants, the majority of whom work for small employers. My testimony today focuses on financial emergency savings, worksite financial planning and education, and views on how best to expand retirement plan coverage. The COVID-19 pandemic illustrated how ill-equipped many Americans were to manage financial emergencies. Among our clients, the incidence of financial hardship withdrawals in 2020 increased by 280% when compared with 2019. We encourage Congress to consider financial emergency savings legislation with 3 key principles in mind. First, provide workers with penalty-free access to a financial emergency savings withdrawal from a retirement plan. Second, limit financial emergency savings to mitigate leakage from retirement plan accounts. And third, enable participants to repay financial emergency savings withdrawals when their financial circumstances improve. Another way to assist workers in saving for financial emergencies is to provide more resources for worksite financial planning. This committee should consider a separate hearing on financial literacy. The fact is, children can get a credit card before they learn how to manage debt. Children learn to consume and spend before they learn how to save and invest. Our children become adults who enter the workforce ill-equipped to budget, invest, manage debt, and to save. That lack of knowledge contributes to the financial stress that plagues millions of Americans. The cost of financial stress in lost worker productivity and increased staff turnover is estimated at $500 billion annually. Indeed, my experience engaging with hundreds of employers and thousands of their employees confirm worksite financial planning enhances both worker financial and emotional security. In support of those measures, we applaud proposed legislation that would allow incidental expenses related to retirement plan design to be treated as plan expenses, and we recommend that Congress act to pass legislation clarifying this status and, in the process, expand access to financial planning and education for working Americans. Among employers with more than 100 employees, 87% of workers had access to workplace retirement benefits. In contrast, among employers with fewer than 100 employees, only 58% of workers had access to workplace retirement benefits. And yet there are 32.5 million small businesses in the United States, which represents nearly 50% of the American workforce. Why this disparity? The greatest barriers to retirement plan adoption among small employers are, first, the costs of workplace retirement plans, and second, the administrative complexities placed upon small employers. Legislation should address both of these barriers. For example, employers must provide several documents to retirement plan participants. We were pleased when the Labor Department permitted a shift in default delivery from paper to electronic mediums. One study found retirement plan participants' costs could be reduced by $500 million annually by converting to electronic delivery. Unfortunately, some continue to press for an erosion in these efficiencies, not just for the employer, but for participant accessibility of this information, which in electronic form can be readily translated to languages other than English, as well as enhanced for those who are visually impaired. The reduction in cost and complexity of delivery, as well as the enhancements in participant accessibility, will encourage more small employers to establish workplace retirement plans, thereby expanding retirement plan coverage. In addition to lowering participant plan costs, Congress should also focus on increased retirement plan coverage. There are 25.8 million part-time workers in America, nearly two-thirds of whom are female, many not covered by current workplace retirement plan designs. The Secure Act of 2019 positively changed eligibility rules to require employers to provide access to retirement plans for long-term part-time employees. In Senator Murray's Women's Retirement Protection Act, the legislation would enhance upon the Secure Act provisions to provide access to an even greater number of part-time workers. I believe it is important for even more workers to have access to a retirement plan, including those who do not work 500 hours. And I would like the opportunity to discuss with the committee how best to accomplish that. Beyond the ideas shared in my remarks, we support other legislative proposals discussed further in my written testimony. We look forward to continued collaboration with the members of this committee to preserve, protect, and expand the U.S. retirement system so that everyone can plan and save for a dignified financial future. Thank you.
Thank you very much. Ms. Rademacher.
Thank you, Chairman Murray, Ranking Member Burr, and members of the committee. Thank you for holding this hearing today. Retirement, savings, and savers have long been a bipartisan bright spot in Congress, and I'm grateful to you for carrying that tradition forward. I'm Ida Rademacher. I am a vice president at the Aspen Institute, and I lead our financial security program. Our goal is to make financial security a top national priority, and since our inception, retirement savings has been a pillar of that work toward building a more inclusive economy with reduced wealth inequality and more deeply shared prosperity. My written remarks include a broad list of the challenges and opportunities facing our country's retirement savings system, including issues like portability and lifetime income. But I'll focus my remarks today on the foundational role that retirement savings play in wealth creation, the importance of closing gaps in access to retirement savings, and the potential for boosting emergency savings through the retirement system. Retirement savings are one of the largest sources of household wealth in the United States, second only to home equity for most households in America. The wealth-building potential is important, not just for the rich. Everyone needs wealth to thrive, and our research team has found that wealth functions in a variety of ways in a person's life to provide resilience, choice, mobility, physical and mental well-being, dignity, and legacy. Too often, conversations about retirement savings carry an implicit or an explicit assumption that low and moderate income households don't need savings because Social Security replaces much of their income. But given the critical role of wealth in the quality of life and the goals that we all have, the claim is false. It is essential that we build a retirement savings system that works for everyone. We still face a number of challenges, and far too many workers lack access to this powerful system. Account ownership and balances are distributed unevenly across socioeconomic groups, racial groups, generations, and gender. And of particular note, disproportionate lack of access to workplace retirement savings has deepened the racial wealth gap in this country. In 2016, the typical Black household had 46% of the retirement wealth of a typical white household, and Latino households had 49% of the retirement wealth of a white household. But there are promising solutions for policymakers to take action to begin to close these gaps. Further expanding coverage to additional part-time workers is one of these solutions. This would help women in particular, and women of color in particular, who are more than twice as likely as men to work in voluntary part-time jobs. Expanding the market for multiple employer plans to include more workers, such as those at a nonprofit organization, could also move the needle by lowering costs and providing economies of scale that are closer to those achieved by large businesses. Encouraging auto re-enrollment in retirement savings is another promising solution that would build off the success we have seen with automatic enrollment. And as workers change jobs with increasing frequency over the course of their working life, leaving a variety of small accounts scattered across different financial institutions, solutions like auto portability and a retirement savings lost and found database are vital to ensure the retirement savings system is designed for the needs of the 21st century workforce. Finally, I want to raise the key opportunity for this committee to consider to strengthen the retirement savings system and have it serve the greatest number of Americans successfully, and that is supporting households in saving for emergencies. A study that was released just last week by the Consumer Financial Protection Bureau deepened our understanding of the critical nature of emergency savings, finding that households with emergency savings were substantially less likely to overdraft, to take on high-interest debt, or to withdraw early from their retirement savings. These findings corroborate recent research we initiated during the pandemic that found that households with at least $1,000 of emergency savings were half as likely to withdraw their workplace retirement savings accounts compared to those that didn't have any liquid savings. You have a particular opportunity to significantly boost emergency savings by allowing providers to offer automatic enrollment into workplace savings accounts in the same way the tool is used for retirement savings. When automatic enrollment became the standard feature of 401k plans in the US, participation nearly doubled, with 93% of new hires contributing. I'm happy to answer more questions later, and thank you for your time. I want to commend again the committee for your leadership on this critical issue of retirement savings, and I look forward to the conversation.
Thank you very much. Ms. Hansell.
Good morning. Thanks to the committee for inviting Weiser to participate in today's hearing. I'm Cindy Hansell, president and founder of the Women's Institute for a Secure Retirement. Our mission is to educate and inform women so they are prepared financially and to support opportunities for them to secure adequate retirement income. This brief statement will cover why women, the National Resource Center on Women in Retirement, and 3 interventions that are workable solutions to the challenges that women face: emergency savings accounts, targeted retirement literacy, and auto portability. Why women? That's the question that we're often asked. And the answer is there are nearly 6 million more women than men at age 65, and almost 70% of the over 85 population are female. Many of those in the 85-plus group end up living at the poverty level, even if they've never been poor before. While it's well documented that many Americans are not prepared for retirement, the future for under-resourced women is alarming. Women have a more difficult time saving for reasons commonly acknowledged: lower wages, time spent either out of the paid workforce because of caregiving, or working part-time, which is why women make up nearly 2/3 of part-time workers, 64%. Also telling a big part of the story is that while women are 46% of the total labor force, they make up 69% of low-wage workers. These women have little access to benefits or financial wellness programs. Many also work all their lives with little to no savings to show for it. Yet the financial hardships due to the COVID economy highlight the importance of having a cash cushion to get through hard times. The research finds that working women want to take control of their finances and their retirement. They want access and they want more financial education. They want to know how to overcome the knowledge gap. Since women generally live longer, they need to have more savings that will last longer. Emergency savings are foundational building blocks for the unbanked and for moderate and low-income women, as well as for many employees who just agree that they want to enroll in a workplace emergency savings program with payroll deduction if offered by their employer. The findings from the Federal Reserve finding the 39% that were unable to cover a $400 unexpected bill has highlighted the need for policymakers to help workers to save more and to find ways to use the employer plan structure to make it less burdensome with linked emergency fund accounts. Wiser's focus is on expanding its turnkey emergency fund model with the credit unions for at-risk women to establish accounts and begin saving. Encouragingly, these model programs help these groups of women access matched savings accounts, allowing them to better their finances. The National Resource Center on Women in Retirement is Wiser's key initiative. It's a national clearinghouse, and through our partners, we have access to diverse groups of women to train trainers in their communities by providing helpful resources and experts to lean on. We've directly reached hundreds of thousands of women through these workshops and our partners, and reach millions with our publications. Our target populations include women from many job categories and from many demographic groups. What they all have in common is they want access to basic, trustworthy financial information and access to accounts and how to deal with the various financial decision points along the way. Their message, quite simply, is tell me what I need to do and show me how to do it. A recent report finds that $400 billion has left the retirement system since 2015. That headline points to the importance of a tech-based solution developed by the Retirement Clearinghouse. It ensures that when someone changes jobs, their 401k savings move automatically from the old plan to the new plan, even if their assets are less than $5,000. That allows their savings to continue to grow in one easy-to-monitor, consolidated investment account. The best thing about AP is that the more financially challenged demographic groups, those with the smaller balances, lower their cash-out rates more than other groups when it's a feature of the plans. In conclusion, Wiser helps workers do the best they can within the system that we have now by providing financial literacy and capability programs, educating and advocating for a much-needed and simplified Savers tax credit, and helping women without access to a workplace retirement plan to be able to build emergency funds. Thank you for listening.
Thank you very much. Mr. Chittenden.
Good morning, Chair Murray, Ranking Member Burr, distinguished members of the committee. Thank you for inviting me to speak today on the critical issue of retirement security. My name is Doug Chittenden. I'm Head of Client Relationships at TIAA, where we provide retirement services to 5 million employees at more than 15,000 employers in the not-for-profit community. I especially want to thank Ranking Member Burr, my home state senator, for inviting me to testify today, and I'm proud to be part of the more than 5,000 and growing employees TIAA has in North Carolina. I want to commend the HELP Committee for its bipartisan efforts to advance proposals designed to enhance retirement savings for American workers. Our country's retirement savings system has evolved over time, and today I will share some steps Congress can take to continue to ensure we have an effective system. The first, in our view, most important step is expanding access to lifetime income solutions in employer-sponsored retirement plans, and most specifically, those that would provide the highest returns for retirement investors. Over the years, the retirement system has shifted from a pension plan and defined benefit structure where employers would provide guaranteed income in retirement to one that is designed more to focus on accumulation of assets through defined contribution plans. This has transferred the risk of making investment decisions and providing retirement income from the employer to the worker. The result is Americans face a projected $4 trillion retirement income gap, and more than 40% of households are forecasted to exhaust their savings during retirement. To address this gap, defined contribution plans are evolving to increase in-plan access to guaranteed lifetime income solutions through annuities. Annuities are a vital and sensible solution as they provide pension-like income in retirement as well as guaranteed returns in the savings stage. Because most retirement savers today are defaulted into an investment option in their plans, it is important that employers have the option to incorporate the best annuities into these default options. Unfortunately, current regulations discourage employers from including the most effective lifetime income options on their plan menus. Fixed annuities with delayed liquidity features would offer retirees the potential for higher returns and retirement income as a part of a default investment option. TIAA is asking Congress to amend the Department of Labor's default investment regulations to provide employers with more latitude in designing their default investments. A bipartisan House bill, the Life Income for Employees Act, would amend the regulations to allow a guaranteed lifetime income component with delayed liquidity features as a default investment option. This legislation would expand the options available to employers in their selection of an appropriate default investment for their employees. For employers looking to establish the guaranteed income features that were a hallmark of defined benefit pensions, this bill would give them a much-needed tool to offer personal pensions to their workers. This is vital to addressing the future lifetime income needs of retirement savers. We ask the committee to consider modernizing these regulations. Congress can also take steps to increase access to retirement savings plans. One of the biggest deterrents to small employers adopting retirement plans is the cost of starting, administering, and maintaining the plan. The SECURE Act took steps to address this by enacting improvements to multiple employer plans, MEPs, or pooled employer plans, PEPs. MEPs and PEPs make it easier for small employers to leverage economies of scale and join a single retirement plan. Unfortunately, not-for-profit employers were not included, but proposals being considered by this committee and others would fix that. We've been encouraged by how some of our clients have come together and improved upon their existing retirement plans using the MEP structure as it exists today. Other steps that could be taken include improving access to plans for long-term part-time workers, simplifying plan disclosures, and increasing incentives for starting plans. Finally, improving retirement savings should be an additional area of focus. A recent study found 1 in 4 Americans have no retirement savings, and those who are saving are not saving enough. There are several ways this can be addressed. These include increasing the use of automatic enrollment features, which have been very successful at assisting Americans to save more, allowing for employers to make matching contributions based on payments employees are making on their student loans, and helping those who leave the workforce to care for family members catch up on missed savings opportunities. I commend you, Chair Murray and Ranking Member Burr, for holding this hearing today. Thank you for the opportunity to testify. On behalf of TIAA's 5 million retirement plan participants and 15,000 employers, thank you for your bipartisan commitment to improving and modernizing the current retirement system. And I look forward to answering your questions.
Thank you very much, and thank you to all of our witnesses today. We will now begin a round of 5-minute questions. I again ask my colleagues to keep track of your clock and stay within those 5 minutes. Ms. Rademacher, the Aspen Institute recently found that 40% of Americans reported they would struggle to afford a $400 unexpected emergency, and 1 in 4 families now say they have no emergency savings at all. We can improve financial resiliency by helping Americans save for those emergency expenses, and it would also, of course, bolster retirement security because people could tap designated emergency savings accounts rather than take from their retirement accounts and put their future financial security at risk. How can emergency savings accounts help keep one's retirement accounts intact?
Thank you, Senator. It's a great question. And there has been a number of organizations really doing some deep research, listening and learning about the role of emergency savings in short and long-term financial stability. We certainly know from the Consumer Financial Protection Bureau, when they look at the drivers of financial well-being long-term, liquid savings has the highest explanatory value of any other facet that they looked at in terms of that. So it goes to consider that when we're talking about expanding access to retirement savings and we want that experience to be successful for individuals, that the concurrent ability to save for emergencies and create that liquid savings is important. We recently published principles for design of emergency savings, and one of the things that's important for this committee is that there are a couple of examples now of within-plan emergency savings. It's important for behavioral, in terms of behavioral psychology, to have a specific bucket that is deemed for emergency savings that is separate than your retirement savings, but they can work together, and then Erisa could provide guidance to do this kind of co-location of accounts, sidecar accounts, if you will. It is true that the emergency savings needs of households is that statistic you provided from the Survey of Consumer Finances from the Federal Reserve is true about the lack of emergency savings. And also, as we look at post-pandemic and the experience we had looking at the CTC and the payments, as those goals have gone away, liquid savings becomes even more important, and facilitating that savings automatically, like we do with retirement savings. There's a lot of research around the opportunity for that, both here in the US, but also in the UK, where there's pilots underway to look at automatic enrollment into emergency savings within retirement plans.
Okay, thank you very much. Mr. Contreras, an important piece of the retirement puzzle is making sure that those who have employer-sponsored retirement accounts don't forget about them when they leave a job. According to the Bureau of Labor Statistics, the average person holds 12 to 13 jobs in their career. Nearly half of those jobs are held from the ages of 18 to 24. If someone started saving for retirement right after college, the savings from that individual's first employer-sponsored retirement account would have grown tremendously by the time they retire because of compound interest. And it's important that they remember that those accounts exist. Senators Warren and Daines actually have a lost and found bill that would create a national registry to try to help reconnect Americans with their retirement accounts. Can you talk with us about how such a registry would be beneficial for both plan sponsors and participants?
Of course, Chair Murray. Thank you very much for that question. A national registry would absolutely help the participants locate missing retirement plan accounts, and we would cheerfully embrace that type of an approach. We would recommend pairing this with an employer safe harbor as it related to missing participants, where an employer following a specified procedure would be able to automatically distribute retirement plan accounts into, say, an individual retirement account in the name of that participant and for that participant's benefit. And certainly the role of government can help to facilitate participants accessing those missing accounts. That safe harbor would be an important relief for employers today because currently automatic IRA distributions are limited to accounts of $5,000 and below. However, a necessary condition for this to work is also to enhance the investments within automatic IRA rollover accounts. More specifically, today it must be invested in a capital preservation investment option. We would suggest following defined contribution plan participant-directed rules around a qualified default investment alternative with respect to automatic rollover IRAs. The combination of all of that legislation will lead to much better outcomes for participants.
Okay, thank you very much. Senator Burr.
To all our witnesses, thank you for being here. Doug, TIA seems to be increasingly involved in multi-employer plans. They follow the same funding rules as a single employer plan, but they allow employees to band together to tackle the job of administration cost, administrating the plans and the cost. Can you talk about the potential of this type of plan designed to close the access and savings gap?
Thank you, Ranking Member Burr. The ability for, as we've been discussing, one of the primary impediments that small employers face in offering retirement benefits to their employees is the costs of starting and maintaining a plan in addition to managing it on an ongoing basis. The ability to band together and share those costs across employers is, we think, a tremendous benefit and an opportunity to increase participation. The rules that were made available through the Secure Act were an important step forward. As my remarks indicated, we'd like to see those rules expanded to include employers in the not-for-profit space. We've seen some tremendous benefits already with many of our clients. We have associations of small independent colleges in now 10 states that have come together and formed multi-employer plans, providing more access, better benefits, and lower costs to their employees by doing so. We think this structure offers a lot of promise and is a great way to increase access to millions of Americans.
You're also supportive of action that we took for unrelated employers to pull together to offer a single retirement plan. But I understand that ensuring the provision captures 401(b)s is important. Can you give us some examples of how recently enhanced law is helping clients and how an expansion of flexibility for 403(b) will help employers in teaching, medicine, and research?
Yep. The rules that we're proposing would be expanded to include 403(b) plans that are currently available in the 401(k) space, provide for more flexible structures. Under the current rules that are available to 403(b) plans in the not-for-profit space, there needs to be sort of a common nexus or a common organizing group to bring the employers together. And for our clients, this is typically an independent college association in a state or an association of independent schools or those types of organizations. If by liberalizing the rules that are applicable in the 401(k) world, that common nexus could be payroll providers, financial advisors, other entities that are able to share costs or bring together clients that they work with in a much more flexible and open way that we think would increase access.
Thank you. Ida, recognizing that the gig economy is here to stay, and we're not going to go back to a traditional employee-employer relationship, what can we do to help this universe save for retirement?
Thank you, Senator. It's a great question. We start at Aspen thinking about all workers, no matter where they work and how they get paid, and how they're going to navigate increasingly complex financial life. And so the overall direction we need to head is that we need to find a way within a retirement savings system in this country for gig workers to be able to save as well for retirement. There are a couple of places to look at the moment. First, there's, at least in California, when some of the states are taking the lead on some of the retirement savings expansion work, some states have designed that so that all workers can save into those systems. And then, of course, this also gets to the key of the portability issue, because many people who are working in the gig economy also have a W-2 form of work or are very fluid between these places. So I do think there's incremental steps to take toward this piece, but of course, part of that is around the overall design right now of an employer-based system and how to navigate that. I do think that the main next steps will be around thinking through the mechanics and the guidance for portability, and then thinking about how we can then leverage that new expansion to enable a conversation about gig workers as well.
Great, thank you. Thank you, Madam Chairman.
Senator Casey.
Chair Murray, thank you, and I want to thank you and the ranking member for this hearing, and especially your work on these issues that surround retirement. I wanted to start with Ms. Rademacher regarding a piece of legislation that I have. I wanted to start by noting the numbers here. The Bureau of Labor Statistics finds that nearly 24 million Americans are part-time workers. We know that many of these workers don't have access to workplace retirement plans due to their part-time status. In fact, less than half, 40% of these 24 million Americans have retirement plans through their employers, so a much lower number than we would hope. The Secure Act took an important step forward by requiring companies to include these workers in employer-sponsored retirement plans after 3 years of employment. Senator Tim Scott and I are seeking to build upon this progress through our bill, the Improving Part-Time Workers Access to Retirement Act. That's Senate Bill 3751. This bill would require employers to expand retirement plan eligibility to part-time workers after just 2 years of employment, not 3. So I wanted to ask you, how do you believe this legislation would improve part-time workers' ability to both save and plan for their futures, particularly for low-income workers?
Thank you again, Senator, for the question. We agree that the ability to increase the percentage of participants that are in part-time work in retirement savings is one of the best ways to take a next tier of progress toward an inclusive retirement savings system. To your point, 42% of part-time workers currently have access to a workplace retirement plan compared to 81% of full-time workers. So by decreasing the amount of time that one would have to be employed with a specific employer, that's going to do an important job at expanding who has access through the existing system. That's going to disproportionately help, again, women, people of color, and many others who choose especially and need, especially after COVID, to have flexibility and part-time work as part of the work going forward. The other piece of this that opens up is, it goes to some of the ideas about automatic re-enrollment, which is that while 41% have access right now and 81% of full-time workers do, it's a smaller percentage who actively participate. And there's very good reasons at any point in time when someone may choose not to be able to save, but to re-scoop into that within a cycle every 3 or 4 years means that people have an ongoing opportunity to reconsider that option, and is another way that the combination of expanding options for part-time workers would go further.
Thank you very much. My last question is for Ms. Hansell. I want to thank you for your testimony before the Special Committee on Aging in January. And while bipartisan legislation like SECURE expanded retirement access for many workers, significant disparities still remain. These disparities are especially significant for women, as you've noted, who often spend time out of the paid workforce to serve as family caregivers, as well for communities of color, workers in communities of color who face systemic barriers to building wealth and savings. Ms. Hansell, what types of retirement policies would help address these disparities, specifically for women and people of color?
Thank you, Senator, for your question. I think that it's difficult because caregivers, especially, and so many other women that are working in those, trying to balance their family lives, have very little control over their hours. And so what happens is the eligibility rules, I think, just, keep them out. I mean, it keeps them out because of the hours. A long time ago, I was working with a group of retail workers out in West Virginia, and I had never heard about this, that so many of them who were part-time workers would just get sent home. They'd drive in, they get there, and then they get sent home. So they never got those hours that are required, and I think that's what really, stops people. So unless we had an auto IRA or some, great plan that everybody could jump on, I think that's what's required.
Thank you. Thank you, Chair Murray.
Thank you. Senator Smith.
Thank you, Chair Murray and Ranking Member Burr. I really appreciate this hearing, and I appreciate the bipartisan focus on retirement security. I think it's important to note that we know that the typical black and brown family has significantly less wealth than a typical white family, and this is very true for Native families as well. And it's also true that retirement and pension policy is really complicated. It's complicated for policymakers, it's complicated for people who should be benefiting from these retirement products, and the details matter, right? Because they can have a huge impact on a person's financial security and our efforts to address wealth inequality in our country. So, Ms. Hansell, I'd like to bring up with you a very specific example of what this looks like for tribal members living on tribal land. So, for many years, tribal courts have successfully handled family law cases, including Native families, adjudicating difficult questions around custody and alimony and more. And tribal courts are often the first choice for tribal members who have the choice of resolving their disputes either in tribal court or in state court, but they choose tribal court. But so here's the specific problem. Under current federal law, orders from those tribal courts about how to allocate retirement plan assets in a divorce aren't recognized. Only state court decisions are recognized. And so what this means is that in many cases, a Native family needs to go to state court for relief. Native women, in most cases, would need to go to state court for relief instead of the tribal court where they reside. Or what often happens is that one party simply isn't able to access the resources that they are due from their former spouse's retirement plan. And more often, of course, than not, that is a woman who is left much worse off. So this seems like an unfair limitation on the courts of these sovereign tribal nations, and it hurts Native families. So Ms. Hansell, can you just tell me what you think about this issue, how you see this issue?
Well, I mean, I think Quadros, we could be here for hours talking about those issues. But what I remember from our work in New Mexico was that there was no law sort of linking the tribal court with the state, and so you had to decide like where you would have your divorce, which could be harmful in many ways. And the Retirement Equity Act of 1984 was where Quadros were first, instituted. And I think if we're waiting for the states one by one to be passing laws or doing something to fix this, then, really we need a legislative fix, a federal legislative fix.
Well, thank you. I agree with you. I think that sort of doing a series of one-off state-by-state resolution of this just ends up creating more complexity, makes it, and something that's already really hard for people to understand to begin with, including this senator sometimes. Yep. I think that makes it more complicated. So it sounds like you would agree that this is an important issue that it would be good for Congress to take up and try to help resolve.
Yes.
Great. Thank you. Thank you so much. Let me just also stay with you. We were just talking about how women generally face a loss of significant amounts of family earnings and retirement security in the face of it when they are confronted with a divorce. And a lot of times, current law has loopholes that allow one spouse to transfer or even hide retirement plan funds without the permission of the other spouse. This is one of the reasons I'm so glad to be a co-sponsor of Senator Murray's Women's Pension Protection Act to help address this unfair transfer of wealth. Can you just comment on this legislation and why you think it's important?
Yes, I'm not really familiar with that provision, but I do know that there's I think there's a GAO report that's going to look into all of those issues. And when you work with women, you get everyone has a story. Anyone who's gone through a divorce has a story. And so I think it's complicated in so many ways that we really have to make sure that we're taking a close look at, what the solutions are for it.
Yeah. Thank you so much. I think this is particularly a place where being careful and thoughtful and diving into the details to make sure that these policies deliver the result that we all can probably agree on, both for Native women living in tribal land and also for Senator Murray's bill is a great example of that. Thank you very much, Madam Chair.
Thank you. Senator Rosen.
Thank you, Chair Murray, for holding this bipartisan hearing, and to you and your staff for their work crafting bipartisan retirement legislation. Financial security for Americans in retirement should not be a partisan issue, and I really appreciate you bringing all of us together to discuss this today. And so retirement plans that employees access through their employers, well, they're so important to saving for retirement. Savings are automatically deducted from workers' paychecks, allowing them to benefit from tax-free treatment of retirement savings without even thinking about it. That's what employer-sponsored pension plans are designed to do. There are also optional plan design features that can make it even easier to build savings, such as automatic enrollment, where businesses can require employees to opt out, meaning that many more will essentially choose the default of opting in, and automatic escalation, where businesses offer their employees the choice of automatically increasing their retirement plan contributions periodically. But under current law, employers must pay out of pocket to add these optional plan design features. So for many small business owners who want to help their employees save more for retirement, the out-of-pocket cost of adding these features is too great a burden. So to address this, I'm currently working on bipartisan legislation that would allow employers to add these features and have the fees for adding these optional design plan come from retirement plan assets, making it easier for small businesses to offer their workers high-quality retirement plans. So, Mr. Comentros, I'm sorry, I'm probably not saying that right, but as an advisor to employer plan sponsors, can you give us your thoughts on why only a small number of businesses with fewer than 50 employees offer plan design features that help workers save for retirement, like auto-enrollment, auto-escalation, when the vast majorities of companies with more than 1,000 employees offer them?
Thank you, Senator, for that question. And you illustrated the issue here perfectly there in your remarks. There are challenges that small employers face with respect to administrative costs of plans and the complexity of plans. Those are the greatest barriers to new plan adoption. But even for those employers that adopt plans, those issues still persist in operation of the plan. There's also some issues with respects to small businesses engaging with their consultants with respects to consultative services that would provide for beneficial features in these plans, like auto-enrollment and auto-escalation. Those discretionary features today, under current law, would need to be paid by the employer. They cannot be treated as a plan expense. So unfortunately, many small employers simply don't have these conversations with their consultants. The legislative solution that you proposed is precisely what we need to help encourage these types of conversations and provide these more beneficial features to the small employer market segment as well.
Well, thank you. We hope to be introducing that soon, but what other recommendations might you have for me to incentivize all businesses to offer workers competitive retirement plans, financial education, like you just mentioned, and other benefits?
Thank you, Senator. We would love to see considerably more expansion of worksite financial planning and, of course, expansion of retirement plan benefits, particularly in the smaller employer segment where the coverage gap is so pervasive. So to that end, any type of financial incentives that can encourage these types of plans in the form of tax deduction, certainly, and with respect to worksite financial planning, very specifically, today, any such benefits that are provided by an employer, while it could be deductible to the employer, would constitute a taxable benefit to the workers, despite the fact that worksite financial planning has yielded tremendous results. So to the extent that we could make this a non-taxable benefit to workers, and to the extent that it could be a deductible benefit for employers, those incentives would provide meaningful results.
Well, thank you. You know, 99% of businesses in Nevada are small businesses, so this has a real impact on my state if we're able to do that. I'd like to continue on with you for the little time I have left. I appreciate your testimony on disparities in retirement savings, and this crisis is particularly acute in communities of color that impact states like Nevada, where diversity is our strength. Millions of Americans, hundreds of thousands of Nevadans 65 and older have income below the poverty threshold. And Black and Hispanic seniors are even more likely to fall into poverty as they age. So, Ms. Hansell, as an example, you cite statistics showing that Hispanic and Black women are twice as likely to age into poverty than white women. So I want to pick up on what Senator Casey asked about disparities, Ms. Hansell. Tell us more why women and people of color are more likely to have lower savings in retirement, and how you think we here in Congress can address it.
You need your mic on.
The coverage and the access issues, I think, are just different. If you don't work in a place where there is a retirement plan and you work for a small business, often you just don't have access. And so even if you want to save in some way, how do you do that? And people always, say to me, well, anyone can go into, an institution and open up an IRA. But, you know, what do we have, like 11%? I think that actually do that, and people are often doing it just with rollovers, not with new, you know, opening up with a new plan. So I think that's the problem for not just, it's for low-wage workers generally, that there isn't a way to save. I mean, that, you know, we're doing these little projects where we see people are so grateful that there's some way that they can sign up with the credit union where there's some small account to start an emergency savings. And we need that, you know. I mean, I remember the auto IRA from 20 years ago, you know, in a way that if employers could do that and there were incentives, it would just make a big difference.
Thank you. Thank you, Madam Chair.
Thank you. Senator Hickenlooper.
Great. Thank you, Madam Chair, and thank each of you. We've been watching you on TV as we go between different hearings, but it is something that really is of crucial importance. Now, according to the Federal Reserve, 75% of the bottom half of income distribution, the 3/4 of those people in the bottom half don't have a retirement plan at work. But more concerning, according to the Federal Reserve, those in the bottom 50% by wealth have a median retirement savings of 0. And I think, obviously, we need some more innovation in our retirement savings options so that middle Americans can participate and build wealth. And Ms. Rademacher, I was going to ask you, since I have a long history with the Aspen Institute, could a retirement savings plan that has low costs and a federal match and easy to understand investments, could that work for that spectrum of workers?
Absolutely. Thank you for the question, Senator. The retirement savings system we have in America is, and as I said in my early remarks, when you look at the survey of consumer finances in America, the two places that 80% of Americans have wealth on their balance sheets are home equity and retirement savings. And that is when we have a system that I like to say has one hand tied behind our back, because we actually aren't engaged with over 50 million Americans having an opportunity to save in that system. Americans want the opportunity to save for their future. They need help in a couple of different ways. We need to remove the friction from that process as much as possible, which, to the points that we've said, is making automatic enrollment there, making it available to any worker, no matter the size of the employer, or even in the long run, you know, moving this to figure out how we work with gig workers. People will save. An incentive and understanding too, and this is a different jurisdiction than the Help Committee, but there are differentiated ways that individuals are incentivized to save, right? If you're in a lower tax bracket, you get less of an opportunity to save on the dollar, right, than if you're in a higher tax bracket. There's lots of different ways that we can make this easier. We have seen in places where states are leading, we've seen in other countries, that when you have a system that's all in, people not only save, they take pride in that, and they take pride in the idea that their workers are able to save. So I think this is a solvable problem. I think it is a problem that we can solve on a bipartisan basis in this country, and I think financial security at the household level is a critical piece of long-term economic growth in this country.
Hear, hear. Mr. Koumentaris, and we've heard about how many small business workers have access to a retirement plan, and you know it's roughly half, or maybe a little over half. And I know as someone who spent, you know, at least up until I was 50 and got the harebrained scheme that I'd run for office, but I was in small business and really saw that the barriers that when you're running a small business there are to a plan and trying to deal with it. And our office has been working with Senator Collins to figure out a way to remove administrative obstacles for small businesses. And you've seen the Bipartisan Secure Act group of plans and pooled employment plans provisions that will allow small businesses to pool resources, which at the same time will use economies of scale and be able to set up retirement plans at much lower cost. So how can we balance the streamlining the compliance procedures while still making sure we have sufficient oversight?
Thank you, Senator. A very important question. As you touched upon, group of plans offer real promise for small employers, as do pooled employer plans. But there are important distinctions between the two. The Labor Department recently came out with guidance with respects to audit requirements as it related specifically around group of plans, and we are concerned that that may create some issues for smaller employers. You see, small businesses today that sponsor a retirement plan that is smaller in size is not subject to an audit requirement. Accordingly, their administrative costs are a bit lower. Now, if a small employer wishes to participate, or I should say join a group of plan, which provides certain administrative efficiencies, a consolidated trust, same set of investments, single Form 5500 filing, and an audit were required on the entire group, then obviously that small employer would bear a portion of those costs. Our suggestion would be to free the group from any audit requirement, but any larger employer that otherwise would be subject to an audit on its own, to have an audit apply for that larger employer that's part of the group of plans. The other piece of this, though, is to ensure that the Form 5500 filing that would be required for the group should not be held up merely because an audit for one of those larger employers is incomplete. Together, that combination would make group of plans still a very viable option for small employers in the future.
Great, perfect. And I have other longer questions which I'll submit in writing, but I'll, at this point, return back to the chair. I'll yield back my time.
Thank you very much. I see Senator Braun is here. We'll give him a minute to sit in his chair. Senator Braun, if you're prepared to go next.
Thank you, Madam Chair. Been listening with a lot of attention on this issue. For small businesses, finding the proper vehicle for offering employees retirement, of course, is a big issue. I think it's been well covered so far. The biggest issue I hear, and I was one of them as an employer, because my company had 15 employees for a long, long time before it was large enough to where we could afford the overhead of providing any type of retirement to our employees. And of course, do that. Of course, the larger you get, the easier that is to do. But I want to take a different track and get your opinion on what I hear all the time that would be a prelude to actually the question of retirement. In Indiana, in most states, I think it's 16 million jobs across the country are in need of middle skill jobs. In other words, in my own company and across the state of Indiana, the largest manufacturing state per capita, we struggle with what you need to get before you actually have the consideration of a retirement plan. Employees that are coming from our educational system that in many cases stigmatizes the pathway for what most businesses are looking for. That's a better high school education. And then if you need to polish life skills and what you learn in high school, which we did 40 years ago all the time through a curriculum that was more geared to that. Currently, 529 savings plans, I hope you're all familiar with that, but it enables taking funding to all the areas that the marketplace is currently not having a problem with, 2- and 4-year degrees. In our own state, we ship out more 4-year degrees than we use within it. Senator Klobuchar and I have a bill called the Freedom to Invest in Tomorrow's Workforce Act that would simply say, with that tool, give it to businesses to train kids in those skill sets, that it's the number one issue when I'm traveling Indiana is workforce. And you got to have a workforce for those high demand, high wage jobs before you're ever going to get into the further discussion of what you do with retirement. Love to hear your opinion, each one of you, on whether that makes sense simply to take 529 savings and make it available for certificates and workforce training along with everything else it does. We can start with Mr. Chittenden down here and move across and tell me what you think.
Thank you, Senator. And we totally agree. The 529 plan structure has proven to be a benefit to millions of Americans, allowing them to save for college, junior college, and even other advanced degrees. I think the idea of being able to expand utilization of those benefits for other types of education, whether it's offered through your employer and other places, makes a lot of sense, because at the end of the day, that's what it's about: helping employees, helping Americans get ready to fulfill their careers and support their families. So on the face of it, it seemed like a good idea.
I'm not so familiar with that, so I think I'll pass. That sounded good to me. But other than, getting myself stuck into something that I really don't know, I have an opinion on, I'll pass.
Thank you, Senator. It's a great question. And I think that you're raising an important issue. At Aspen, we talk not just about the functions of wealth in a household's life, but the conditions for building wealth. And there's a set of preconditions that a household has some level of routinely positive cash flow, just like a small business needs that, right, for its health and vitality. Beyond that, households need investable sums. They need a way to amass those. And 529 and retirement savings are some of the most successful vehicles we see for how households help with that. One of the other functions of wealth, though, that we talk about is how it gives households choice and agency and dignity around their own path and their own way of creating legacy for their families. And the idea of expanding the usage of 529s to give households broader choice around what are the kinds of skills they need to build for the jobs they see today, I think respects households. I also think that there's probably a lot of important research to go into that before coming up with the definitive recommendation. But there are, I know, even at the state level, a few state treasurers that are looking at ideas like that as part of making 529s a more widely useful tool for households and for the economy.
Thank you.
I would certainly echo the sentiments that we just heard, providing some increased flexibility and choice for families as it relates to their 529 plans and how those funds will be used, for what purpose, and expanding educational programs that would qualify certainly seems on the surface of it a very reasonable and prudent proposal.
Well, thank you. And I think the fact that half of the kids that pursue a four-year degree end up not making it to the finish line, a third of them that do not have a marketable degree. And of course, we need that, but almost all the jobs that are begging are in that category of needing a more polished high school education and access to certificates to get into the highest demand, high wage jobs that are out there ready to go. Hopefully the committee will take a look at that down the road, this bill that Senator Klobuchar and I are sponsoring, and maybe be able to weave it into something. Thank you so much.
Thank you. Senator Burr, do you have any final comments? I have a few more questions. Ms. Hansell, I wanted to talk to you a minute. We've heard a lot about ways to help Americans save for retirement through defined contribution plans. I want to briefly shift to defined benefit plans, where benefits are based on the years of service and where employers may offer employees ready for retirement a lump sum amount or lump sum buyout for their pensions. A GAO report found companies were offering lump sum buyouts without key information people needed to make informed decisions. What sort of risks do lump sum buyouts pose to participants, and how can proper notice and disclosures help them make informed decisions?
I guess what I would say that the best that I've seen was when I was part of the Erisa Advisory Council 7 years ago. And the de-risking people came in and, spoke to us so that we could write a report about what would be the best opportunities for people. And, it takes real counseling for people to understand all of a sudden that they're getting this huge lump sum and what that means. And we know that there's a recent study out from the MetLife that they've repeated from, I can't remember, a pot of gold, I guess is what it's called, and, shows that people spend their lump sum within 5 years, it's gone. And it's often referred to, like the lottery winners that all, spend the money and they don't realize that it's going to be gone. So I think there needs to be real counseling and education. That seems what works best. And to find out what disclosures people need to know about. Like, people will think that the plan offers a certain, benefit, and then they find out that it doesn't. I think it's a big issue.
Yeah, the law governing retirement or risk requires that notices and disclosures be understood by the average plan participant. And GAO separately found that nearly 40% of 401k plan participants do not fully understand the fees they pay on their retirement accounts, which, and many of them aren't even aware they pay a fee at all. So maybe I can ask you, what can Congress do to improve transparency so we increase retirement security and help people across the country really make the best financial decision for their family?
I don't know. Could you re-ask that, please?
Well, what should Congress do to improve transparency?
Well, I think there needs to be better disclosure is what it is, so that people know exactly what they're getting and what it means, and so that it's not a surprise, because that's what I've heard so many people come and say, my husband just got this huge lump sum. We thought it would be the best thing for us, and I think we made a big mistake. And we didn't know this, or we didn't know that there were, certain benefits that we would have been able to get for a spouse. So I think that's the key thing, is letting people know and requiring that, the information is there because you've asked for it.
Okay, Mr. Chittenden, you mentioned in your opening statement the need to offer lifetime income solutions for retirees during the spend-down phase of their retirement. I really support innovative solutions to help Americans plan their golden years so their retirement savings last as long as they're needed. This is an important topic, both for the individual saver and for the economy, and I want to make sure that we approach this issue from all angles. So in addition to making enrollment into lifetime income investment products the default for employees, what other steps can we do to help retirees with their future income needs?
Thank you, Senator. Clearly, most Americans don't realize that their 401k plan or their defined contribution plan does not include a provision to provide a lifetime income in their retirement. So I think it's absolutely essential to continue to make that education. At one of our clients, Yale University, 3 years ago, they made the decision to include lifetime income payments or lifetime annuities as part of their default option. By making that decision, they've increased the projected retirement income for each of their employees on average $6,000 a year. That's not just the professors, that's the maintenance staff and the clerical staff and the support workers across the board. That's the power of having the lifetime income options as part of the default option. So really changing the conversation from what is my basket of money, how much is my accumulation, to what do I really have in terms of lifetime retirement income, that's the key.
Okay, thank you very much. And I want to thank all of our witnesses today and all of our colleagues who are here for their very thoughtful questions. I want to thank Mr. Kuman-Tros, Ms. Rademacher, Ms. Hansell, and Mr. Chittenden. Thank you all for coming, sharing your advice and expertise today. I'm actually very excited to roll out what I've been working on with Senator Burr soon, which addresses a lot of the issues that were talked about today, and I believe our discussion here will help us strengthen all of the bills that we're putting together. And I just want to note that I especially appreciate the discussion about the need to add lifetime income into defined contribution plans so people can be sure their retirement assets will last. And I hope we can include ideas that achieve the right balance here in our legislation. For any senators who wish to ask additional questions for the record will be due in 10 business days, April 12th at 5 p.m. The committee will meet next Tuesday, April 5th, for a hearing on reauthorizing Food and Drug Administration user fees. Committee stands adjourned.